Hi, and welcome to your weekly macro roundup, where we talk macro, try to make sense of markets that really don't make any sense, and answer your questions so we can become better investors. I'm your host, Steven Van Metre, and I really appreciate you being here today with me. And I got a great show lined up. And how did the market play out this week? Boom, stocks and yields went down. The relationship is starting to come back together again. Isn't that interesting? Because what did we see last week? The market tried to get yields to creep up to validate higher stock prices. And then today, or this week, we see the two moving in tandem. Obviously, the economic data is completely deflationary. I mean, if you're looking in the data as we do every week, you're not finding any growth, but yet the market is just hung up on the speculative fever of buying stocks and trying to make the market go higher because they believe the economy is just going to magically rebound. They believe there's going to be not just a V-shaped recovery, but like a super V where stocks are just going to, or the economy is just going to shoot even higher than before. Of course, people don't remember we were headed into a recession before the coronavirus came along, but hey, who am I to say that they are right or wrong? But nevertheless, that's what people believe, and they're buying stocks because they believe stocks have memory. They're saying, hey, the stock was trading up here, it's now down here, I have to buy it. And they believe the Fed can still magically make stock prices rise. Sometimes I wish I was that naive. Maybe investing would be a lot easier if I just pretended the world worked differently than it did. But let's take a look at the economic data and see what's going on there. Let's start back with Thursday's data. And what did we find? Producer price index actually went up on a monthly basis to 0.4%, but really what matters on a year-over-year basis, it's down 0.8%. And when you strip out food and energy, on a year-over-year basis, it slowed from 0.6 to 0.3%. So coming into the factories, producer prices are falling. What does that mean is going to come out the other end? Lower consumer prices. No surprise there. Let's move on to that evening, Thursday evening. If you're watching the macro data, you found some more deflation, and that was out of South Korea, the export price index. So this is the prices paid of exports, fell on a year-over-year basis, not by a little bit, by a whopping 8.2%. That's substantial. Now, when you think of this from a global trade perspective, when South Korea exports, where is it going? Europe, United States, major consuming nations and nation states. Well, what do you think is going to happen? Do you think those retailers are going to say, oh, well, hey, we can make a margin of 8.2%? No, they're going to bring prices down. So South Korea is exporting deflation, but they're also importing deflation. And look at how big of drop import price index was down 12.8%. from this time last year, slightly better than the month before, but still, the world is importing and exporting deflation, and you'll see as we go through the rest of the data. Now we move on to Friday morning, and we're seeing a lot of April data now start to show up, and of course, it's going to be ugly. We knew, you don't have to be psychic to know that the capacity utilization in Japan, industrial production out of Japan, were going to be lower. And that in the United Kingdom, it was going to be a bloodbath in construction data, or construction output, and GDP, in industrial production, all ugly, ugly, ugly numbers. What we want to see is what we can find that's more current, which is May. So let's look into the Eurozone. We see French CPI. Now, I don't know what's going on with the French economy, but it seems to be better than some of the rest of the Eurozone. And we see consumer prices ticked up slightly. In Spain, however, we see contraction in consumer prices for the second month in a row, down to minus 0.9% on a year-over-year basis. And that is not good. So a little inflation in France, deflation in Spain. How about for the rest of the Eurozone? Let's see, we have industrial production in May, massively declining, no surprise there. And then we move into the United States data this morning. Export prices on a month-over-month rose 0.5%, but look at on the year-over-year basis. So the United States is exporting deflation because our export prices fell minus 6%. Slight improvement over last month, but we're still exporting deflation. How about import prices? Well, there you see those South Korean prices coming across, for example. Import prices fell 6% from this time last year. Again, slight improvement over last month, but that is still not the issue. The issue is the United States is both importing and exporting deflation. So one thing you'll hear in the markets is you'll hear that higher stock prices beget higher stock prices. Well, the same is true with lower stock prices. They beget lower stock prices. Once you're in a deflationary spiral, it's really hard to stop because you can see South Korea is importing and exporting deflation. We're importing and exporting deflation. At some point, it does stop, but I want you to see it is not stopping just yet. Back to the data, let's see. Consumer expectations have improved. Not really a big deal, preliminary data. So let's move on to the import price index against the consumer price index. So here you can see import prices in blue on a year-over-year basis are falling. And what does that translate into? Lower consumer prices. And you can see the two have a pretty nice relationship, and we can zoom that into the most recent expansion. And you can see they have a very nice relationship, as you would expect. Because if import prices are falling, well, so are consumer prices. They're going to get passed along. So until this really starts to change direction and bottom out, there's no change in direction of the consumer price index coming. Let's go take a look at how the banks are doing. And wow, what a bunch of surprises here. Hate to say I was right, but this is interesting. We'll take a look at this. Securities and bank credit, big jump of looks like $51 billion total. Much of it coming in mortgage-backed securities. So here we see an increase of $10 billion and non-mortgage-backed securities, or what are called U.S. Treasury securities, increased by $34 billion. So there's $44 billion of insured bonds that were bought. And then if you tack on the non-insured bonds that the banks bought, you get a total of $51 billion for the week ending June 3rd. Now, where's the relevance of that? Well, let me show you in the charts. And that's not what we want to see. Here we go. Week ending June 5th, right here. So this week here, as I mentioned, it seemed like the big buyers just stepped out of the way to let prices fall because they wanted to buy. Well, look at that, $51 billion worth of bond buying. We see it in the price charts here, just as I thought we might. Pretty cool to be right every once in a while, isn't it? All right, let's go on to loans and leases and bank credit, and a big drop in lending. So we could see, looks like 35 and 6, almost 17. So that's $52 billion worth of loans and leases now being paid down and gone. Much of that coming out of commercial industrial lending. Real estate loans fell. Looks like $8 billion. That is significant. We'll look at that on a year-over-year basis shortly. That's a big deal when you start to see real estate loans drop. And it was mainly out of the residential space. Commercial real estate loans fairly flat. Here they are. And how about consumer loans? Well, one nice thing from the consumer space is there's some flattening out here. So consumer loans, after just dropping every week, only dropped $1 billion this week. Credit card pay downs were only $2 billion, which is still significant, still contraction here in the consumer space. But for 1 week, not as bad as it's been the last couple weeks. Is this a potential bottom, or is it just a brief reprieve in the way down? We'll see in the weeks to come. Let's go take a look at the charts. And we've got the M2 money supply. The growth rate is 23.27%. It's flattening out and starting to roll over. 6-month rate of change is flat at 19%. 3-month rate of change is just under 16% and starting to fall. But the real question is, from the perspective of inflation, is what's going on with institutional money funds, and we can see that they are falling by $12 billion. So money is clearly flowing back into the equity market, which we kind of obviously noticed if you've been watching the markets at all. And that tells us, because the biggest component of the M2 right now is this institutional money fund. So as this goes down and the M2 starts to flatten and head down, what does that mean for inflation? Well, it means it is going to be deflationary. And we know that because the monetary base, which was not updated this week, is still rising. The Fed is still committed to buying $120 billion per month through his quantitative easing program at a minimum, as we learned this week. And the money multiplier, because we do not have an update on the monetary base, it was ticked up slightly from 3.48 to 3.49. Again, zero signs of inflation in the money multiplier. And as you recall, a falling money multiplier is deflationary. This is the short-term pulse of inflation and deflation. You want to know what's really going on? The money multiplier tells you that, and it's simply the M2 money stock divided by the monetary base. The Fed controls the monetary base. We as consumers and investors control the money stock. So that's where you get the two. If the money stock starts to fall as the monetary base continues to rise, and it should because the Fed's buying $120 billion a month, then we should see a continued move down in the money multiplier and see deflation continue to move its way through the global economy. Real estate loans are in trouble. The growth rate slid again down to 3.77%. The 6-month rate of change is down to 1.05%. And the 3-month rate of change, and remember I said this probably might go negative in like a month or so. Big drop from around 0.55 to 0.22. And this is about to contract on a 3-month rate of change. And this does not happen very often. It rarely happens outside of recessions, but this is not very good. Even though we've seen a tick up in or continued demand for new mortgages, and then last week an increase in refis, it's still not enough to slow this train down, and that is bad news in a debt-based economy. When debt slows down and then even worse contracts, it adds to the deflationary theme of what's going on in the economy. Commercial industrial loan growth rate is down 27.56 from a year ago, as we see commercial and industrial borrowers are doing what? They're paying back their short-term credit lines with money they receive from equity issuance and debt issuance. 6-month rate of change is falling, 3-month rate of change is falling, and to make matters worse, the loans and leases and bank credit, when we add them all together, the growth rate is down to 9.97, and the 6-month rate of change is just a little over 7% and falling. The 3-month rate of change is just under 6 and falling. And it's only up here because of commercial industrial lending. But remember, this downtrend, thanks to real estate loans rolling over and about to turn negative on a quarterly basis, bad news. Consumer loans still falling down 7.43% from a year ago, although we did see in the weekly data the slowdown, which was nice. Is it a bottom? Hard to say. Seems unlikely at this time with 20 million people on the unemployment line, which I think I forgot to cover in the data. So we still have very high continuing claims. In fact, we'll go and I'll pull that chart back up so we can take a look at it, because that is actually fairly important and worth going back to take a look at. So let's go do that. And if we go to Thursday, so here you have continuing jobless claims in the U.S. sitting just around 21 million. This is a huge problem because the states are not designed to handle this many people on the unemployment line, and it's literally bankrupting states' unemployment benefits, and is going to force them to cut spending, lay off people, and guess what? That's going to feed back into more people losing their job. And as the states spend less, that's all the businesses that feed in off of state money. That's slowing down. Tax payments are slowing down, and the thing kind of continues to spiral until it eventually stops. So the fact that even though the initial jobless claims beat expectations by only having 1.5 million people file claims, the fact is there's too many people on the continuous claims, meaning they've filed claims more than 1 week, and this is just downright deflationary and bad news overall. All right, let's switch gears and come back to another thing that I had on my mind this week, and just getting the next set of PowerPoints loaded up, is what was going on with the banks. And so when we look at what Fed Chair Powell said, and it was very important because he told us that quantitative easing was going to continue. And I was kind of wondering, like, all right, so obviously the data today validated my claim, because it was strictly a claim and opinion that, hey, we'll call it a win because I was right, but that's not going to happen every day. That the banks wanted to accumulate more long-term bonds. Now, why was that? Well, I dug into the data, and I want to show you what I was looking at. So I pulled up the schedule for this coming month, or the remainder of the month and now it's not going to load. Let's refresh, see maybe there's a problem. There it goes. And I went back earlier in the month and the remainder of the month, and we have some very large 20 to 30 year maturity purchases starting on Monday, the following Monday, and then following Wednesday. And these were pretty substantial amounts. And I went back and I added up what the Fed is purchasing in 20 to 30 year maturity bonds. It's a little over $10 billion last month. Now we do know that the Fed's QE has shrunk a little bit from last month. So let's just round it off, say they're going to buy $10 billion of long-term U.S. Treasury. The next question that came up was this. Well, if they're purchasing 20 to 30 year, and then in other places they purchase 7 to 20 year, where do the new 20 year bonds show up? Are they here in the 20 to 30 or 7 to 20? Do they split it? That's a good question. So I pulled up the Excel spreadsheet, and you can go back and look. I'll just show you. Not on this page, and maybe not on the other page if it's slow enough. But anyways, you can download an Excel spreadsheet that shows what they've actually purchased. And so I did that, and what I found out is the 20-year maturity bond falls into the 7 to 20 year, not the 20 plus year, because when an auction happens and the U.S. Treasury auctions the 20-year bond, and the securities dealers buy it, and then the banks buy it, there's at least 1 month that passes. And I went and looked at what the Fed was buying, and 7 to 20 year included anything that was 19 years and 11 months old. So they're buying that new 20-year debt, but they're buying it under the 7 to 20 year block. Nothing in the 20 to 30 year block was a brand new minted 20-year bond. They were all 30-year bonds of some flavor between the last 10 years of issuance. And what is interesting is how much debt we're actually is falling into the hands of the securities dealer. So let me show you the auction results. You can go to Treasury Direct, and under bond, you can pull up the 30-year and the competitive results. So we see securities dealers, which are called primary dealers. So direct is domestic bidders, indirect are foreign bidders. So out of an approximate $10 billion the Fed is buying, the dealers, which we'll assume sell this entire amount to the banks, the commercial banks, who then in turn sell it all to the Fed. That means there's an approximate $5 billion per month shortfall where there's not enough new issuance to eat that up. So why would the banks want to let prices of Treasury bonds fall? They needed more inventory. And what's interesting, as someone who is very, very bullish Treasury bonds, this tells me that if we're running $5 billion that the Fed needs to buy that the market is not supplying, they have to get from the open market. And that's great news. So that means the commercial banks, once they chewed up this supply, are going to have to go out to the market and then get more 30 years to flip to the Fed. And what is that going to do for interest rates? You got it. So I was very, very interested in this, and we'll see how this plays out, because there's 3 big auctions coming for Fed QE purchases at $1.75 billion, 3 times through the 25th, and I'm not sure if they're doing anything after because they haven't posted their schedule. But if my view or theory on this is right, that should be very bullish for Treasury bonds as the banks, pass this entire new issuance off to the Fed and then have to go out and replenish it. So I'll be very interested in seeing how that plays out. Now let's go take a look at some charts and see what's going on over here, and we'll pick up some of your questions. All right, let's start by talking about the bond market, and we'll look at yields first. And there was this big demand of, oh look, interest rates are finally going up, inflation's finally here. And I said, no, it's not. And sure enough, just as fast as it went up, it reversed. Now what happened today, we need to actually go and look at a little more granular, which is why I like to look at TLT, because it's a 20 plus year Treasury bond fund, and my for whatever reason, this charting program does not does not run yields all the way to the end of trading day. It stops at 30 minutes early. And I don't know why, but it's just what it does. And what we could see is we came out of this supply zone. Prices rallied up, as we would expect now that we know that the commercial banks were buying all those supply down into here. And potentially now that we know that there isn't a supply in the market for what the Fed's going to be buying, and prices got driven up. Now think about this. If the commercial banks were buying the week ending here, so Friday, Thursday, Wednesday, Tuesday, Monday, what do they want to do with those bonds? Those $51 billion worth of bonds they bought, what do you think they want to do? Do they want to flip them to the Fed for a loss or just break even? No, they want to flip it to the Fed for a gain. Now, when you understand the gain is that all the banks are getting out of this is more reserves. So the commercial banks are buying these bonds with their reserves. And then they're selling them to the Fed to get those reserves they can't touch that are held at the Federal Reserve Bank. So they want to net more. I mean, why wouldn't they, right? So what we should expect is them to drive bond prices up and interest rates down so they can make a profit on those QE purchases that are starting on Monday. So it'll be interesting to see what happens go into the next couple of weeks in bond prices, because we know the banks bought a bunch of inventory here that they're going to flip. Now, we don't know exactly how the inventory is broken down, but we know they bought some. So what we can see here is we have buyers down here and sellers down here. And these are called supply zones. And I do very basic technical analysis. I want to know where buyers and sellers are at. And there's kind of an easy explanation. We can even use a football analogy. This is the offense down here trying to drive prices higher. And this is defense up here trying to keep prices from going higher. And in their case, trying to drive it lower. And how do we know that? Because you can see buyers here shooting prices up. Sellers, defense pushing them down. Buyers push the offense back up. Defense pushing down. Offense coming back strong. Big play, big drive here. Defense holding the line. Goal line stand. Pushing back. Offense making another run at the line. Didn't quite score. Defense pushes back. Offense is running out of steam. They've been on the field too long. And all of a sudden, the defense pushes the offense. Big sack drives them way back down the field. And the offense gets a second wind and says, hey, we're going to come out of the gate swinging. The defense says, we got enough margin here. We'll back off a little bit. And boom, the offense is right back at the line. And the defense came in and said, whoa, wait a second. We got to put the brakes on this. And what you see is up here is called resistance. What is the resistance? The defense. The defense is creating a stand here. And this is support or offense. This is where the offense is strong. They're buyers here. And as we zoom in today's chart, what you can see is they came up to the line of resistance and the defense stood. And the defense pushed back. The offense came and pushed back against the defense. Defense pushed them down. And by the end of the day, they really had accomplished nothing because it opened and closed roughly at exactly the same level. What is critical, though, is when we zoom out, say, on a 30-day chart, what we can see is the offense has been a reasonable player right at this price level down in here. Now, I don't have a line there. So this is a zone where the offense has been playing, and what we want to see from an offensive standpoint is them push prices up and push the defense back. So the question is the defense worn out from being on the field this long, and can the offense push them back? And ultimately, can the offense push the defense and drive prices way up and create a big play, a big score? That's what we're looking at from technical analysis. Now, there's a lot of people that do it in a lot of different ways. I just want to know where the buyers, where the sellers, and at some point we know the sellers are likely to lose this because the large commercial banks have to go source bonds for the Fed's big long-term bond buying appetite. How about the dollar? Let's take a look and see how it did. It came down into a supply zone where buyers have been, and sure enough, found some buyers. That also helps bond prices a bit because we know the two have been connected. And the fact that the dollar didn't rally as much as bond prices did this week is possible why there was some pushback on them today. How about emerging markets? I think we have a question coming up. In fact, why don't we just go to the questions and then we'll come back and take a look at emerging markets. Let's see what we've got question-wise. All right, thank you for this. Great as always. You're very welcome. In an earlier video this week, you mentioned that it would be odd how the recent Treasury auction did not fully sell through, and you theorized perhaps the commercial banks were waiting to buy because they believed that prices would be better after Powell's presser or some future event. Did you hear anything in today's FOMC? So this question came in either Wednesday or Thursday. Points that confirm or disproves that theory. Well, no, the Fed didn't talk about it, but we just kind of went over that. It looks like I was right on that call. It seems like today was merely just the Fed announcing that nothing is changing. You got it. Nothing really did change. So does the partial auction action still remain a mystery? It does. The Fed will never say anything why, but we kind of have a clue why. So thanks and thank you. All right, let's go on to the next question. In your previous videos on YouTube show, you said that gold is going to have a pullback since emerging markets are moving sideways, and 9 out of 10 times gold will follow EEM. Is this one of the 10 times where I see EM rising up to catch up with gold now? Thanks for your time. I appreciate it. There's a second question, which very similar, is what has EM crossing over the line of death done to your theory of deflation? It's done nothing. I mean, there is still deflation. I mean, there's no inflation in the data. Does EM's recent rally reflect changes in the underlying liquidity in emerging markets? Or does it reflect Trump's recent regulation of investing in Chinese financial assets and a restructuring of the EM ETF due to its ties to Chinese finances? Hope you're doing well. Thanks. I am. Hope you are too. Let's take a look at the chart. In my opinion, is you're just seeing a flood of money coming into the markets, and the rising tide raises all ships, and including emerging markets. And all it did was come up, hit this resistance level, which we can go back and see a pretty decent resistance level. Let's go back on the weekly chart. So it got through the line of doom, and it would really need to get through this line here to validate something. But if it gets rejected here, well, then odds are it's headed back to the line of doom or a retest of it. The reality is, even though EM kind of pushed through, there is no signs of inflation in any of the data anywhere at all of any form. So this to me is just investors trying to chase stock prices higher. And like I said, a rising tide raises all ships. So it doesn't change my view at all, but it is interesting. Another excellent video, Q&A Saturday. Well, guess what? You're going to get another one. This one. Hope you like this one too. You're welcome. Thanks for always answering my questions. I appreciate it. Thanks for sending them in. One major step in global world dollar liquidity is that consumers purchase foreign-made goods and services. That is correct. What happens that cycle if more purchases start shifting domestically because we start onshoring and producing more locally, i.e. globalization starts to crumble. Methinks more deflation because less dollars in the global economy. Correct. So one example you use is someone purchases a foreign-made car. Let's say it's a Honda because it's easy and I know they go through final assembly in the U.S. Some of them do. I don't know if all of them do, but I do know some of them do. How does that support the foreign leg of the cycle? That is a great question. That car was produced and sold in the U.S., so theoretically those dollars really never leave the U.S., or is it just a really long chain of saying you buy the car locally in the U.S., as part of the chain, those dollars eventually go back to Japan in form of yen and make it back to the U.S. How would that happen? To pay local salaries and payroll of U.S. workers. Thanks for entertaining my question. You got it. All right, so here's how that would play out. Those Hondas are foreign cars that are built in the United States. All their parts are not built here too. So you can only imagine that final assembly means parts are being sourced from all over the world. So potentially there's a large number of parts for Hondas, for example, being sourced in Japan or various parts of Asia. So those parts, as they come here, get paid for and sends dollars back overseas. The other side is, where is Honda's corporate office? It's in Japan. So while there is a U.S. office, where are the ultimate destination of profits? Back to Japan. Where does the design come from? Probably a lot of it in Japan. So there's a lot of stuff that's going on in Japan for the Honda. Now, is it as much as if the Honda was manufactured and assembled in Japan? No, but dollars are still flowing back over there. Is it as much? No, but you're right. If we see this return to only buying, say, in the U.S., or you see Europe only buying inside Europe, or Asia only buying inside of Asia, it really doesn't help world dollar liquidity at all. We do need money to cycle back over into foreign economies. Now, whether it's, you get on an airplane and fly to Europe or Asia and go on vacation and spend dollars, or you buy something that's made by a foreign company, or you hire someone that works in a foreign country and pay them in dollars. We need dollars to flow around the world. And that's another reason why this emerging markets chart doesn't change my opinion, because if you look at import and export prices falling, that's not inflationary, that's deflationary. So why are stocks up? Well, sometimes people just chase stocks higher because they're hoping to front run something that's not showing up in the data. All right, let's see what else we got in the questions. Oh, that looks like it. So we do have a Q&A marathon coming up, so check that out on Saturday. I'm Steven Van Metre. Appreciate you taking time to watch. I'll see you tomorrow. Bye now. The content of this video is provided as education information only. Is not intended to provide investment or other advice. Materials not to be construed as a recommendation or solicitation by or selling security, financial instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre on personal capacity. The opinions expressed in this video that I'm on do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial.